Welcome back to If the Public Only Knew. In episode 3, we're going to tackle the hidden dangers of bond funds. Believe it or not, once you understand just how different these investments are than real bonds, you may have a hard time believing, like I do, that these things are still out there, and ironically, misunderstood by almost everyone in the investing public. And I have to say, the average advisor doesn't understand it much better. So why are they there if they don't work? Well, in things like 401ks or people that are very unsophisticated and don't want to bother, they think, with buying individual bonds, they seem like a pretty good idea at the time. The problem is that they just don't work. As many of you know, I've trained thousands of financial advisors, most of them at Merrill Lynch. But since I left Merrill a couple of decades ago, I've been training advisors all over the street. Let me share something I've told thousands of advisors over the years. More money has been lost reaching for yield than at the point of a gun. Now, I didn't invent that saying. I'm not sure who did, but it's very, very true. When I was at Merrill, we were training advisors there. I used to start this conversation with a simple question. If a fixed income investment doesn't have a stated maturity date and a fixed coupon, what exactly makes it fixed? The room would usually go quiet because it's a trick question. It's not fixed at all. Yet that's exactly what investors are getting with bond funds. Let me share a real example from my practice. When I was actively managing client portfolios, I had a couple come to me with their statements. They wanted my opinion, but they were quite proud of their conservative portfolio because most of it was in what they thought to be conservative bond investments. Not so fast. Most of it was in bond funds. So I asked 3 simple questions. When do you get your original investment back? Quizzical look. How much will you get back? More of a quizzical look. What exactly will your income be over time? Well, they couldn't answer either of these questions. And when they went to their prior advisor couldn't answer them either. So, after 4 decades of experience, here's what I know about bonds. They're simple. They come due. They're not supposed to make you money. They can make you rich. They're there to provide a counterweight to your equity investments over time. They may move around in price, but you want to know at the end exactly what you're going to get back. You want predictable cash flow. You want that income to come in regularly, and you don't want to wonder if you're ever going to see your principal again. What's the difference between owning an actual bond and owning a bond fund? Let's think about it. When you buy a bond, you get 3 things. You know when you're getting your money back, you know how much you're getting back, and you know what your income's going to be. You cannot answer that question in any bond fund out there. Let's take a look at another example. Let's say you put $100,000 into a 10-year treasury. It's only paying 2%. Yeah, I know it's low, but that's what it is. But you know at the end of 10 years, you get back $2,000 per year or $20K plus your $100K. Compare that, putting the same $100,000 into a quote-unquote government bond fund. Now, that bond fund may own hundreds of different government bonds with different maturities and interest rates. Interest rates are going to change over that period. They always do. When interest rates go up, the value of your bond investment or your net asset value in a mutual fund drops, period. Rates go up, bond prices fall. Now, at the same time, people don't put additional money in when bond yields are rising. They usually put most of their money in when bond yields are falling or they're terrified. You don't have to go back very far to look at the amount of money that came in to government bond funds following the COVID meltdown in the markets. Most of those bonds were purchased with between 0.75% and 1.5% coupons. If you were in there several years earlier with a 4% coupon, now that's kind of too bad because you're now sharing your yield with everybody else. When I go back and look at the trailing return of most bond funds, that trailing return is somewhere between 1 and 1.5%, all in. That's what you earned. Now, they're also charging you 45 basis points or 0.45% to oversee this lovely investment. So here's what that means. If your total return on the investment, your sales charge is roughly 25% of the return. As an advisor, that might be nice to get, although we get drummed out of the industry. But as an investor, unaware of this because you don't read the thing, it's awful. Plus, you never know what's going to happen. Instead, if you owned a regular bond, it's not going to cost very much to own over that 10-year period, and it's going to work. So the biggest risk also, though, isn't really necessarily with the fees. It is really to never knowing when you get your money back. It just doesn't happen. Rates rise, prices drop. Rates drop, prices rise, but nobody puts money in. So if you need fixed income, here's what I would do and what I've always recommended. You can't guess the future of interest rates. So you should look at what's happening with interest rates and buy what's called a laddered maturity. If you don't need any of that money for at least 3 years, put maybe 25% of it at a 3-year maturity, maybe another 25% of it at a 5-year maturity, maybe a 7-year maturity for the rest, or maybe a 7-year for 25% more, and maybe another 9-year for another 25%. You do not pick up much yield going out beyond 10 years. Also, your bonds are going to be coming due pretty quickly, and you get to try again. If your advisor does not understand how bond funds work as it relates to the cash flow that comes in and out and what it can do to your return, you need a new advisor. Rule of thumb: if something doesn't have a fixed maturity date and a fixed coupon payment, it's not really a bond. It's something else entirely. And that something else might be a lot riskier than you think. So that's all for this episode of The Public Only Knew. Join us next time when we'll explore why the best financial advisors focus on mitigating or reducing uncertainty rather than chasing returns. Don't forget to subscribe, leave us a review if you found this helpful, and pass it along to your friends or other people you might know that invested in bond funds. They'll be glad you did. Thanks for your time.